Is China the great investment for the rest of this century, or a house of cards? I'm Jack Otter, editor of BARRON'S.com. I'm here with Andy Rothman, the chief investment strategist at Mathews Asia. Thanks for joining us, Andy. So one of the many things that we hear with all this focus on China is you can't believe those numbers. It's always exactly 7% growth, not 6.9, not 7.1. That can't be real. Give us your thoughts.
Yeah, well, part of the answer to that question is I'm not all that concerned whether GDP growth is really 6.5 or 7. Anywhere in the world, we really don't invest in the GDP growth number. We're looking into it a lot more detail. But I think also one of the reasons people are concerned is they're focused, for example, too much on electricity consumption without realizing that there's been so much change in the Chinese economy that that's not the right way to measure things.
Coal consumption, less iron ore is being used. We see all this massive demand from China, which has hurt the commodities market, but you're saying the economy is transitioning to a place where even though they're growing, they're just not using those materials.
That's right. So back in the 1990s, all of us paid a lot of attention to what was happening in the energy sector because China's economy was driven by construction and heavy industry. But today, just like in the United States, where there's very little correlation in recent years between power consumption and GDP growth, the same thing's happened in China because most people are unaware that this is likely going to be the third consecutive year where the tertiary part of the economy, services and consumption, is going to be bigger and growing faster than the secondary part, manufacturing and construction.
And this is something that we want, right? I mean, the talk has been that the Chinese economy needed to go to a more consumer-focused economy. That's moving in the right direction?
Exactly. A lot of people who've been bearish about China for a long time have said their primary concern was that China couldn't rebalance away from construction and heavy industry towards consumption and services, and that's exactly what they're doing.
Now, can they do it well enough that we can still see, I don't know what the number is, 7%, 6%, 8%. Can we still see that kind of growth, some sort of multiple of 2.5% that we see in the US in this Chinese economy, even if it moves to a more consumer-driven economy?
China is going to continue to grow a lot faster than every other major economy in the world, but it's also going to continue to decelerate. I'm one of the more bullish guys out there about the Chinese economy. But I also have one of the lowest GDP forecasts for, let's say, 2020 of 5 to 6% growth. But let's remember the base effect. At only 7% growth now, that's multiplied on a base which is 300% bigger than it was 10 years ago at 10%. So the incremental increase in the size of China's economy today at the slower growth rate is 100% bigger than it was 10 years ago, a better opportunity for us.
So looking at the stock market vis-a-vis that kind of growth rate, obviously one of the things that excites emerging markets investors is high growth rates. Where does the valuation, though, look in comparison to that growth rate? If you're paying too much for it, then who cares how much they're growing?
Right, and one of the things that's, of course, happened as the A-share market, the domestic market in China, has come back down, is that valuations have come down as well. So if we look at the median forward PE for the A-share market, it was about 56 in May, but now that the market is down, it's only about 30. And then, of course, we are active managers, so we don't buy the market. And our PE for our China holdings is a fraction of that.
Now, as an American, of course, you think the S&P is what, in the 15, 16% range. So 30 sounds very high, even at greater growth. But am I wrong on that? I mean, is 30 a reasonable market multiple?
That is high. And that's why we don't recommend people to own the market or own the index. And so if you look across all of the China holdings, for example, at Mathews Asia, the median forward PE for us is about 13, which is lower than the S&P.
Now, I know you can't talk specific stocks, but can you give us a sense of sort of the elements of a good investment in China? What kind of companies, sectors, where's the opportunity set?
I encourage people to look at two parts of the Chinese economy, the two parts that are driving most of the growth and represent this restructuring or rebalancing. First, you want to look at the private sector rather than state-owned enterprises. And for example, when I started working in China 30 years ago, there were no private companies at all. Today, 80% of employment in China, all of the new job creation, all of the wealth creation is coming from small, privately owned entrepreneurial firms. And that's where we want to focus, not on the state-owned enterprises. The second focus should be on the consumer and services part of the economy. That's booming. Even though the stock market is down about 40% from its peak, as we talk today, real retail sales growth, adjusted for inflation, is up by more than 10%. Movie ticket sales are up 50%. Chinese tourist arrivals in Japan are up 100%. SUV sales are up more than 30%. That part of the economy is still very strong.
And because as humans we have recency bias, we all talk about down 40%, but year over year the market is up nicely in China.
That's right. As we're talking today, the Shanghai Composite, the main domestic index, is up about 30% over a year ago. So again, beating the S&P 500 on a one-year basis.
Thanks very much, Andy.
Thank you, Jack.